This EMA strategy replaced everything on my chart. I used to stack indicator on top of indicator, taking random confusing trades and hoping that I'd somehow end positive. Then I removed it all and replaced it with this EMA cloud, and then I just took clean trade after clean trade. That was the turning point that finally made me consistently profitable. So in this video, I'm going to break down that exact EMA strategy and how you can start trading it immediately. Let's get into it. Now, the EMA is an extremely powerful tool, but most traders use it incorrectly. They'll either use it as a signal line to enter when the price crosses it, or as some sort of support and resistance line, or as an entry point when two of them cross over. And the issue with all of these is that, number one, they aren't really that effective. They won't really turn much of a profit if you follow them. And number two is that you're not using the EMA for what it's actually meant for. These are all surface level and not even 10% of the true potential of the EMA. So we're going to scrap all this and use it the way it's actually meant to be used. Now, an exponential moving average, simply put, is a line that tracks the average closing price over the last number of candles. So a 20 EMA is a line that takes the last 20 candles, averages out their price, and plots that as a point. Then it does the same thing for the next candle and the next one, and connects all those points into a line. If the next candle closes much higher, then the EMA will be pulled up with it. If the next candle closes the same or a little lower, then the EMA will stay the same or get dragged a little down. It's basically a smoothed out version of what the price is doing right now. And if it's the 50 EMA instead of the 20, then it's the same concept, except with more candles included. Now it's going to take the last 50 candles into consideration, which means it has more data points weighing it down, and it's going to move a lot slower. So that same spike would move the 50 EMA less than the 20. And this is extremely powerful because price action itself is messy and confusing. Trying to read the market with individual candlesticks and structures is unreliable and mostly random. It's the same as trying to take trades with multiple indicators because you don't have a clear, repeatable reference to enter trades. You can't take clean trade after clean trade like this because price action will always look different and you'll interpret it differently every single time. But if you get the EMA to smooth them out, things start getting interesting. And this is where the EMA cloud comes in. This is the 20 EMA and the 50 EMA with the area shaded in between. And the cloud is what really brings out the full potential of the EMAs. So for our EMA strategy, we're going to focus on two main elements of the cloud. Number one is the slope of the cloud, and number two is the width of the cloud. And when you combine these two correctly, you know exactly where to take clean trades consistently and when to ignore all the other noise that drags you down. So let's start with the slope. This is what tells you who's in control at a glance. So you don't need to figure it out or guess by just reading price action. If the cloud is sloping up, it means we're in an uptrend and buyers are in control. This tells us we're more likely to continue moving up. If the cloud is sloping down, it means we're in a downtrend and sellers are in control. This tells us we're more likely to continue moving down. And if the cloud is flat, it means we're in a range and no one is in control. This tells us we're more likely to continue ranging. So the slope is what gives us our bias, and it's objective because it's simply telling us what the price is already doing. We don't need to interpret anything. Now, the slope is not guaranteed to tell you where the market is going. I mean, nothing is. But it does tell you which direction the market is trending in and how strongly it's trending. And that's the most powerful force in the market. That's the only thing capable of telling you where the market is more likely to move than not. So if the cloud is sloping up or down and closely following the price, we can use that as a strong indication that the market will most likely continue in that direction. Now, not all slopes have the same intensity. Some are barely above flat while others are parabolic. Both of these extremes are unstable and not worth trading. So how do we know when a cloud slope is healthy and worth trading? Well, that's where the cloud width comes in. Remember, the cloud is the area between the 20 and the 50 EMA. And the distance between these two is what creates the width. When the price is trending aggressively, the 20 EMA, which reacts faster, gets pulled away from the 50. The cloud gets thicker. That means momentum is strong and the trend has conviction behind it. When the price is still trending but starting to slow down, the 20 starts catching back up to the 50. The cloud gets thinner. This means momentum is fading, and the cloud might even flip and start trending the other way. And in that case, we'd actually start trading in the other direction. Now, the key to taking clean trades and clean trades only is that we want to look for a pocket where both the cloud slope and the cloud's width are aligned. Anything outside of this is not worth trading. Let me show you what that looks like. When we're day trading, we can technically trade time frames from the 1 minute to the daily. But we don't need all that. We're just going to narrow it down to 4 time frames. And all we need to do is check the cloud on each of these 4 time frames, and then we'll know exactly how to trade. We're going to use the 5 minute, the 15 minute, the 30 minute, and the 1 hour. The 5 minute is going to be our entry time frame since it's the smallest and most precise. So here's the exact checklist you need to follow on each of these 4 time frames, starting with the 1 hour. We will mainly focus on slope for the 1 hour. The width is also important, but the thing is that there are only 7 of these 1 hour candles in a single trading session, and the width won't change drastically within that time frame. It's not like we're going to get a wide bullish cloud in the morning and it'll transform into a wide bearish cloud in the afternoon. The 1 hour cloud moves slowly and takes a lot of time to develop, but it's also where the largest long-term buyers and sellers are. So if the cloud is sloping in a certain direction, that'll usually hold for the rest of the session. So we look at the slope on the 1 hour, determine our bias based on how it's sloping, then drop down to the 30 minute. Now the 30 minute is also slow like the 1 hour, so we can also mostly focus on the slope. It's the same procedure as the 1 hour. Then we drop down to the 15 minute and do the same thing. Once we get the slope, we drop down to the 5 minute. The 1 hour, the 30, and the 15 are the 3 higher time frames, while the 5 minute is our lower time frame. So for the 5 minute, we want to focus on both the slope and the width. The width can change drastically here, and we'll be able to get an early heads up here with the 5 minute cloud because it'll start shrinking quickly and even flip. So our checklist is simple and only takes a few seconds. We need to check the slope on the 1 hour, the 30 minute, and the 15 minute. If all 3 align, then we have our bias for the trade. We know where the market is flowing, and we can drop down to the 5 minute to confirm the cloud, then enter the trade. This is what's known as an A+ setup, and it has a super high win rate because all the market forces on every single time frame are pointing in the same direction. This is the closest you can get to knowing what the market's going to do next, without actually seeing into the future. When probabilities are stacked in your favor with the cloud, it's very likely to keep moving in that direction. Let's see what that would look like in the real market. To add it in on your chart in TradingView, just go to the Indicators tab and type EMA Cloud, then click this one. Once you've added it, just go into the indicator settings and change them to 20, 50, and 50. Then it should look something like this. So here we're on the 1 hour. And what do we see in terms of slope? Well, it's clear from a glance that this is bearish. The cloud is sloping down, and the price keeps rejecting it and digging lower. This is a clear sign of a downtrend. If we drop down to the 30 minute, we'll probably see something similar. The 30 minute is just the 1 hour under a magnifying glass anyway, and we see a bearish cloud here as well. Now if we zoom in even further, we'll see the 15-minute cloud, which also has the same downward slope and bearish bias. So our 3 higher time frames are bearish. Now we have our bias. We know it's more likely to continue moving lower, and we can go to the 5 minute to confirm this and enter short. This way we flow with the market instead of trying to guess what the price is doing next with unreliable indicators. That's the only time you want to take a trade because it has a very high chance of moving that way. And by the way, if you want to install this directly into your trading, join the Accelerator program. This is where you'll work with me one-on-one, as well as having a live group and trading room. The link's in the description. Now the question is, what do we do when the clouds don't agree? Well, it depends. If the clouds are all flat or opposite to each other, like for example, the 5 minute is bullish and the 1 hour is bearish, then we don't want to be involved in that. You might take a trade that'll work, but it's not as reliable over time as the clouds aligning for an A+ setup. And our goal here is to just take clean trade after clean trade. But there are times where the 1 hour cloud has a direction, and the lower time frame clouds are a little weaker. Now, what do we do in that case? Well, we don't necessarily need to avoid it because although it's not ideal like an A+ setup, we can still trade them very profitably. So let me show you exactly how I'd trade these. This is the 1 hour chart. Now the cloud is bullish here, but the slope is getting a little weak and it almost looks flat. It's only lightly bullish. And if we go down to the 30, we see that it's just getting flat. And this will get even worse if we drop down to the 15, which shows us that the cloud is plain flat. And the 5-minute will show us the same thing. So what the cloud is telling us here is that the price was bullish before, but has recently started consolidating. That's why the smaller time frames, which react quicker, have started flattening. Now this indicates that it could potentially reverse. The smaller time frames could slowly begin sloping down and take the higher time frames down with it. That's what we need to be aware of, that we'd be less worried about in an A+ setup. But our bias is still bullish. We just need extra confirmation that the clouds will turn higher and follow the 1 hour again. That's usually by a break of a recent high or low, or a break of structure, although that can be tricky depending on where the most recent high or low is and how the structure is looking. And this can be wildly inconsistent, which presents us with the same problem that we had with the indicators. How do we know when we get confirmation and when to actually enter and exit in a consistent way? Well, I use supply and demand levels to make entries and exits automatic. These are based on volume and market activity, so they'll act like price magnets and will be far more reliable than just using previous highs and lows or regular structure. I'll link a video here where I explain exactly how I find them. But the EMA cloud already tells us what our bias should be with very high accuracy. So we have the direction right. Then, all we need to do is trade from one level to the other based on the bias, which will either be bullish or bearish. And this is called the level confirmation and execution method, or the LCE method. We enter at a level, wait for confirmation, which would be the cloud bias, and then execute. Just 3 simple steps. Now let's see the full strategy play out. We want to see a break of structure to the bullish side, but we also need to keep a potential reversal in mind. So all we need to do now is wait for price to break into a level, then take a trade to the next level in the direction of our bias. And so here we see that the price breaks into the upper level. The 5-minute cloud went from flat to finally sloping bullish, and the 15-minute cloud is also beginning to curl up. The 30-minute has started sloping up. And so these are all aligned with the 1 hour now and have a bullish bias. This shift, combined with the momentum from the break into a supply and demand level, is enough for us to enter and go long. So we have level, confirmation, and now we execute. We enter long with our stop under market structure and our target at the next supply level. We let it run and hit the target. As long as we read the EMA cloud correctly, then it becomes a lot simpler to know which trade to take. And that's the full EMA cloud strategy. No indicators stacked on top of each other. No guessing. Just the cloud, the slope, the width, and the alignment across time frames. To recap, check the cloud on the 1 hour, the 30, and the 15. If they all agree, drop to the 5-minute and confirm. That's your A+ setup. If they're mixed or flat, either wait for alignment or look for a structural break to confirm direction. The cloud tells you who's in control. The levels tell you where to enter and exit. And this is the strategy I trade every day, just this and nothing else. And if you want help implementing this into your own trading, links in the description. Be sure to like, subscribe, and I'll see you in the next one.